Hey guys, so in this video we will be talking about interest rate swaps. Okay, interest rate swaps. So what are interest rate swaps? So interest rate swaps are nothing but derivative contracts, right, which can be used by large financial institutions to swap their cash flows, right? So it can be considered as a fixed income derivative, because you are getting a fixed income, you're swapping an agreement and receiving. If someone is receiving, one of the person is receiving a fixed rate, and the other person is receiving a floating rate based on some reference rate, which here we can say it's LIBOR. Now let's try to understand interest rate swaps with a calculative example, right? For example, let's say there is a company ABC, right? There's a company ABC and there is company XYZ. Now companies, this could be any small financial institutions, this could be hedge funds, this could be pension funds, anything. Let's just say company A, let's just say ABC has taken a loan from lender 1 and XYZ has taken a loan from lender 2, right? A big loan, let's just say of $1 million. $1 million. They have taken a loan $1 million. Now just understood that. Now assume it's a reference, it is LIBOR. Now if you are very interested, you should also know that LIBOR is being replaced by something known as a SOFR. It's being replaced by LIBOR from, I think it would be in effect from July or something. Now ABC has taken a loan from lender 1 and XYZ has taken a loan from lender 2. They have not entered into a swap agreement until now. Now what happens is, let's just assume ABC has taken a loan which is on a floating rate. Lender 2 has taken a loan on fixed rate, right? Floating rate and fixed rate. What is floating rate? Floating rate could be something like a LIBOR plus 2%. Now the LIBOR could be anything. It could be a 3-month LIBOR, it could be a 6-month LIBOR, it could be a 1-year LIBOR or something like that. So that you can see on the confirmation document or something. Fixed rate, let's just assume XYZ has a loan of 5%, right? Now A has taken a loan of 1 million on LIBOR plus 2%, and XYZ has taken a loan of 1 million on fixed rate of 5%. Now the main concern with ABC, has that ABC expects LIBOR to increase in future. LIBOR could increase, right? And they are expecting LIBOR, for example, if in period 1 LIBOR is 4%, so in effect ABC would be paying 4 plus 2 for 5, 6. What if they are expecting LIBOR to increase to 5? So they would be paying 5, 6, 7%. So ABC do not want to do that. ABC wants to pay something that is fixed, but they can't do that because their lender is providing a fixed rate. XYZ on the other hand thinks that they are paying more and expects a drop in LIBOR. They expect the LIBOR to drop from 4% to something like a 3% or something like that, and they want a floating rate. Try to understand this. XYZ has a fixed rate but needs floating, and ABC has floating and needs to pay fixed. Now in such scenario, these both parties are going to enter into a swap agreement where ABC, this is the swap agreement, ABC would pay fixed and XYZ would pay floating. This is the swap agreement. Now let's try to understand with an example. Let's just say in period 1, let's take up periods. This is a period 1. Now let's just say the LIBOR, current LIBOR is 4%. Now sorry, one more thing. It is going to pay a fixed of 7% and XYZ is going to pay LIBOR plus 2% as of floating. This is what they have arranged. Now you have to understand, parties can choose to either get into a swap agreement of the whole value or some part of the loan they have taken. So it's upon the contract they have taken. It's upon them, right? It's fixed 7%. Okay, now let's do the calculations. Now one more thing here, ABC has to pay to lender 1. This is not going anywhere, right? So let's calculate that first. We know that ABC has to pay LIBOR plus 2% to its lender. So LIBOR plus 2, that is 4 plus 2, that is 6%. Also one more thing I forgot to mention, this agreement that they are conducting, it would be on a notional value of 1 million. Now many people don't understand what a notional is. A notional is an amount, think about it as a principal amount. This value does not change hands, it's a theoretical value, but we use this value to calculate the interest payments. Okay, it is used to calculate the interest payments. Now 6%, that is there's an outflow of 60,000. A has to pay a fixed rate of 7%, right? That is 70,000. But A is going to receive a floating rate of LIBOR plus 2. What is LIBOR? 4 plus 2, that is 60%, that is 60k. It is going to receive 60,000. So net it is paying net it is paying 70k from its pocket. Now let's just assume if LIBOR increase by 2%. Okay, now LIBOR increased by 2%. Now one more thing, nobody is going to, if you are ever going to the real markets, nobody is ever going to say it is increased by 2%, something like that. They are always going to use something like a bips or basis point. Basis point. So 1 basis point is 100th of a percent. So 2% basically means it. I will say that LIBOR increased by 200 basis points. So that is eventually what you will see. So I would say something like LIBOR increased by 200 basis points. So the new LIBOR increased by 2%, that is new LIBOR would be 4, 5, 6, that is 6%. So what is the calculation? Again, it has to pay lender LIBOR plus 2, that is 6, 7, 8. So outflow of 80k, it has to pay a fixed percent of 7, that is 70k. So it's paying 70k, but it is going to receive, as per the swap agreement, LIBOR plus 2, 6, 7, 8, that is 80k. As you can see, it is again eventually paying 70,000, right? So here 70,000, again here also 70,000. Even when the LIBOR has increased and LIBOR has decreased, it is ABC is paying 70,000. So what we can say that ABC has effectively changed from floating to fixed payments, right? Let's take one more example. If you're still not convinced, let's just assume LIBOR has again increased. LIBOR increased by 500 basis points, BPS, 500 basis point, that is 5%. Now same calculation, it has increased by 5%. Okay, so LIBOR has increased by 5%. 11%. So it would be 11%. The new LIBOR would be 11%. So let's do the same calculation. Okay, again it's going to pay its lender. What was it? It's going to pay its lender LIBOR plus 2, that is 11, 12, 13. 13%, that is, it is going to pay 130,000. It has to pay a fixed rate of 7% to XYZ as per the swap agreement. That is going to be what? That is going to be 70k, but as per the swap agreement, it is going to receive LIBOR plus 2. LIBOR plus 2, that is 11 plus 2, that is 13%, and we know that would be 130k, and these would net out, and eventually again XYZ is paying 70k, which is fixed. So no matter what happens, LIBOR increase or decrease, ABC is eventually going to pay a fixed rate of return on its investment. Now we can do the same calculation for XYZ. Okay. Now in case of XYZ, I think you can understand by this point. I'm going to take the example XYZ. We will take this scenario, period 1. So by the way, this is period 1, this is period 2, and this is period 3. So we have 3 periods, and we have seen that ABC is paying fixed. It has changed from floating to LIBOR, floating to fixed. Now we are taking the example of XYZ, right? So it's 4% LIBOR, period 1. Now we know that XYZ has to pay a fixed percent of 5%. We know that XYZ has to pay its own lender 5%, that is 50k, and it is going to receive oh sorry it's going to receive a fixed of again 7%. It is going to receive 7%, that is 70k, and again it has to pay LIBOR plus 2, that is 456. So it has to pay 60k. So if we calculate this, this would be 10. This would be 40k for period 1. It would basically pay 40. Now let's see in period 2. In period 2, I know that LIBOR increased by 200 basis points, that is LIBOR is now 6%. Again XYZ will first pay its own lender, that is 50k. It will receive a fixed payment of 7%, that is 70k, and it has to pay a floating, that is LIBOR plus 2. So 6, 7, 8, 80k. So it has to pay 80k. So we can see that it is paying 70k, right? It is paying 60k. Now this is for period 2, and this is for period 1, period 2. So you can already see that even though lender 2 of XYZ had a fixed rate, it has converted its net payments from fixed to floating. As you can see, it's 40k, here it is 60k, and we can also see that in period 3 it's obviously going to be different. So this is how we can see that how interest rate swap works. It's very interesting once you understand it. And so what we just saw was a plain vanilla IRS. This is what we call a plain vanilla. So whenever you hear something like a plain vanilla, it means that it is the most basic form. Okay, it's not complex. So something that's complex would be termed as a exotic swap. That's not what we are looking at right now, but that is what exotic names. This is a pure example of a plain vanilla interest rate swaps. This is how a floating rate and a fixed rate change hands. Both parties, there are two legs. There is a receiver, there is a payer, there is a reference rate. Here the reference rate is known as a notional value of 1 million, and this is how the interest rates are calculated, and this is how it's calculated. So couple of more things, theoretical things that I would like to discuss here. So the swaps market confines, so basically swap market is basically a big market, right? In OTC itself, it's a $52 trillion market, swap markets, because every banks, financial institutions use swaps to hedge against interest rate risks and many other risks that arises. Also, mainly we can, in swaps again, we have interest rate swaps, we have cross currency swaps, we have, for cross currency swap consists of your forex, right? So if there is any currency fluctuations, we can enter, banks or any financial institutions can get into a swap contract where they can hedge themselves. Also there we will be talking about something known as a CDS, credit default swap. It's another fixed income derivative which is very interesting. So the swap market is the biggest market in terms of derivatives in the derivative OTC segment, and it largely consists of these things. And a couple of more things. Swap market is basically nowadays every OTC, in OTC segment, major derivative dealers have to sign something known as a ISDA, that is International Swaps Derivatives Association. So as you can see, even this has the name swap in it. So it is highly regulated, and sometimes it could be bilateral or cleared on an exchange, right? So I have seen contracts that are bilateral, and I have seen cleared on exchange. So this could be anything such as a LCH, London Clearing House, or ICE. There are many clearing houses. Also in bilateral, bilateral means there are only two parties that enter a contract and there is no middleman like a clearing house. So this was some general knowledge that I wanted to share. This is the mechanism of a interest rate swaps. I hope you understand something. Thanks.